I think the cameras are on, right? Can BAM control room confirm?
The cameras are on.
Okay, great. Good morning, everybody. Welcome to the New York City Retirement Systems Common Investment Meeting for September 16th, 2020. We are going to start by calling the roll. So let's start with teachers. Mr. McTeague?
Thank you, John. John Adler?
Yes, I am here, Thad. Can't you see me?
Nice to see you. Thomas Brown?
I'm here, Thad. Thank you.
Natalie Green-Giles?
I'm here.
Good morning. David Kazansky?
Present. Matthew.
Russell Buckley?
Did they let you in?
Yep. Fair.
Good morning, Russell.
Morning.
Deborah Penny?
Good morning, I'm here.
Good morning. Susanna Vickers?
I'm going to send you.
Here.
All right.
We have a quorum, John.
Thank you, Thad. Okay, next let's move to NYSERS. Ms. Winery?
Good morning. Chair, Mayor's Office.
John Adler, present.
Controller's Office.
David Jetter for Controller, Scott Stringer, present.
Public Advocate's Office.
Elizabeth Guzman for Jumani D. Williams.
Borough President, Manhattan.
Aldrin Rafael Bonilla, representing Manhattan Borough President Gail Brewer, and also joined by Deputy Borough President Matthew Washington.
Borough President, Brooklyn.
Tanya Cantlow, representing Brooklyn Borough President Eric Adams.
Borough President, Bronx.
Martha Sabio, representing Bronx Borough President Ruben Diaz Jr.
Borough President, Queens.
Alan Swisher for Queensborough President Sharon Lee.
Borough President, Staten Island.
Isaac Gordetsky for Borough President James Otto.
International Brotherhood of Teamsters.
Lawrence Bosley for President, excuse me, Greg Floyd.
Transport Workers Union.
Dave Katzman for TW Local 100 President Tony Otano.
And District Council 37.
Raymond Santander for Executive Director Henry Garrido.
We have a quorum.
Thank you, Melanie. Next, let's move to police. Is Kevin Holleran here? How about Mr. Sens Castay? Okay, anybody from police to read the roll?
Police, Joe Alejandro's here for the PBA.
I know,
So
but
let me start. Okay, so I will do it. So I will
to-
call, yeah, I'll call for the PBA, Joe Alejandro. For the DEA, anyone from the Detectives Endowment Association? Okay, for the Sergeants Benevolent Association.
Anthony Borelli for the SBA.
Okay.
Hey,
So we
Joe,
have
I
Borelli.
can take us off of mute, so I just got it done. I think you can hear me, right?
Okay.
We hear you
Yeah, we
now.
can
You
hear
want me
you.
to finish or you
We
want to
can hear
take
you, Kevin.
over?
No, let's let Kevin do it the official way. Joe, not that you didn't do a fantastic job subbing for him, but let's let Kevin do it.
All right, thanks, Joe, and thanks, John. Did we get to the LBA?
No,
Lou Turco.
Oh, there you go.
Lou Turco, LBA.
CEA?
Johnny Ramirez for Chris Monahan of the CEA.
Commissioner of Finance?
Steve Yuan for Finance Commissioner Jacques Jiha.
Representing the mayor? Mayor?
Dumont, are you there? All right, John Adler representing Mayor Bill de Blasio.
Okay. Representing the controller?
John Dorsett, designee for Controller Scott Stringer.
And in the room with me is Stephanie Zimberg. So we have a quorum.
I just want to say that was all due probably because of our budget cuts. There are less people in the room for police.
That would be, I won't even characterize that statement, Joe. I'll just let that go. Okay, next we have the fire pension fund, and I think I saw Mr. Dunn.
Yes, good morning, all. For Mayor de Blasio?
Cynthia Collins, designee for Mayor Bill de Blasio.
For the controller?
Jennifer Konovitz, designee for Controller Scott Stringer.
Commissioner of Finance,
Phil Dukes, designee for Finance Commissioner Jacques Jiha.
okay, for the UFA, first, congratulations to the new president of the UFA, Andrew Ansbro.
Thank you very much. Glad to be here.
Okay, Robert Eustace,
Present.
Edward Brown.
Yeah.
And for the UFA, Eric Bischoff. Welcome to Eric, reelected back to the UFA and the chair of the pension fund for the UFA.
I'm gonna
Eric stepped. Oh, you hear Eric?
No, I was answering for him. Eric had to step away. He'll be back later.
Okay,
Bob Eustace
so
will hold his proxy.
perfect, thank you. And Peter DeVita for the UFA.
John Young with Peter DeVita's proxy.
Okay, for the UFOA, Jack Kelty,
Jack Kelty's here.
Liam Guilfoyle,
Liam Guilfoyle here.
Paul Mannix.
Paul Mannix is here.
And for Fire Commissioner Daniel Nigro, Terrell Brown is present.
Terrell Brown for Daniel Ivo.
Good morning, thank you, we have a quorum.
Thank you, Pat. Okay, and then turning to BERS, Mr. Rich.
Morning, John. So we're represented today by trustees Natalie Green Giles and Russell Buckley. We do not have a quorum. We will administer this September 22nd. And Donald Nesbitt. Donald, I apologize. I didn't see you in the crowd. Thank you.
He missed you in the crowd. Are there any other BERS trustees that Mr. Rich might have overlooked in the crowd? Okay, great. All right, that does the roll calls. So let me add my congratulations to Mr. Ansbro for your election to the presidency of the UFA. Are there any other new trustees here that should be introduced? Okay, very well. And then let me turn over to someone from the controller's office, I'm not sure who has another introduction to make for a new person in the controller's office. Who's going to do that? Susanna?
Hi. John?
Okay, I'll handle that. So we're joined today by Nisa Alcina, who is the new general counsel for the controller's office. So I would like to welcome her. I think you'll see some of her work throughout the next coming months. So welcome, and we look forward to working with you.
Thank you.
Can you turn your video on, Ms. Alcina, so we can see you? Is that possible?
It is on, John.
No, I think
I'm missing.
He says.
All right. Well, okay.
Morning.
Anyway, welcome to the Common Investment Meeting. So,
Mr. Adler?
Mr.
Adler?
Yes.
I also want to recognize Mr. Matthew Washington, Manhattan Deputy Borough President. He wasn't on the call when you did roll call, but I know he's on the screen now in case people wanted to put a name with a face.
Okay, yeah, Mr. Washington, can you introduce yourself so you'll pop up on our screen?
Sure. Good morning, everyone. Matthew Washington from the Manhattan Borough President's Office. Pleasure to see you.
Welcome. Okay, anybody else? And let me just confirm, Nisa Alcina is General Counsel for the entire Controller's Office, is that correct?
Correct. The mighty controller's office, yes.
Okay. I would sing a Union picket line song about the mighty controller's office, but that might not be appropriate. Okay. So with that, I'm going to turn it over to Chief Investment Officer Alex Donier for the quarterly report presentation.
Thank you, John, and good morning to all the trustees. I trust that you had a nice summer and made the best out of this summer with your families. Today, we have the second quarter performance review and risk report. And as always, we will begin with Mike Haddad, who will present the market overview, trends, and also review the system's asset allocation and tilt in the portfolio. So with that, I'll turn it to Mike Haddad.
I will share the screen for Mike. Please hold for one moment.
Thanks for the intro, Alex. Good morning, all. While we wait for Diane to get the screen together, just a reminder that in my section, I divided into 3 different parts. I talked about the second quarter markets performance, which seems ancient history with the pace of everything going on in 2020. Second part of my presentation is on current and future-looking concerns to markets. And as Alex said, the last part is on the asset allocation as of the end of Q2 for each of your portfolios. So given that, let's just jump in. Next slide, please. So this is the typical slide with the market returns for Q2. With all of your public market asset classes in the first column, the index in which we measure them against in the second column, and the results for Q2 in the third column. So takeaways from Q2 market performance. Big bounce back in all risk assets. As you can see, 16 to 22% returns in public equities. Very strong performance in the quarter. The fourth and fifth line captures your treasury portfolios, and they were virtually unchanged on the quarter as rates were almost unchanged. You did pick up a little bit of coupon income there. And then in credit, the last 2 rows in this slide, credit had very strong performances with investment grade tightening by over 113 basis points in the quarter, high yield tightening by 327 basis points. And just as a reminder, in Q1, these numbers were almost all the opposite of what you see on the screen. So then it begs, next slide, please. It begs the question is, what changed in Q2 for this strong response? You know, and we've talked about this, so I'm going to go through it relatively quickly. We had a historic economic collapse due to the impact of the economy from COVID. And in response to that, we had a massive policy response, both from the Federal Reserve and from Congress in fiscal stimulus. So as to the collapse, on this slide, you see the last 4 quarters of GDP. As a reminder, the way our country reports GDP, we report a quarterly number, but it's annualized. So as you can see in Q2, it was minus 31.7%. I think, if memory serves, the worst quarter in the history of our country. Next slide, please. Echoing the collapse in the economy was the massive rise in unemployment. These are monthly statistics versus quarterly on the previous slide. On the table on the left part of this slide, you can see the unemployment rate. So going into 2020, you can see the unemployment rate was hovering near an all-time low, around 3.5 to 3.7%. Very strong labor market, and how quickly that changed with the shutdown of the economy due to COVID. So you can see the unemployment rate spiked in April to 14.7%. It's been gradually working its way down. The table on the right shows the data behind this, with April being the really extreme number, with almost 21 million jobs lost just in the month of April. Next slide, please. So how does the market, how did the equity market recover with the economy being in such a dire situation? And not just in Q2, but continuing to do so. And again, what I would argue is the policy response. And again, I'm not going to go over all the different policies put forth by the Fed, but they are numerous, both in terms of lowering interest rates, doing massive quantitative easing, as well as many different liquidity programs to support various markets. And as a reminder, there were 4 different fiscal programs passed by Congress, totaling over $3 trillion. The graph on the right does an excellent job of combining these 2 policy responses and comparing them to other times in history. So let me take a second to try and explain this graph. Along the x-axis, or the horizontal axis, is the change in global central bank balance sheets. So it changed pre-crisis to post-crisis. And again, this is a percentage change that's taken place. On the Y, or the vertical axis, again, is a change in government's fiscal deficits pre and post crisis. And the dots on this graph encapsulate the combination of those two. So if you look at the 4 red dots that are in place, I apologize, the lawnmower guys are around my house now. The red dots encapsulate the 4 major countries and what they've done in both fiscal and monetary stimulus and comparing them to previous times in history. So you can see that the combination that's taken place is absolutely massive. And compare that to the blue dots, which is the financial crisis, and you can see how robust this policy response has been. Let me pause there for that, and that concludes my remarks on Q2 for any comments or questions on Q2.
Okay, so let's just review how we do questions, which is to hit the raise hand button by hitting the participants tab, and then under the participants tab, there's a raise hand button. So if you'd like to ask a question, raise your hand and you'll be called on. So I see Mr. Edward Brown has his hand raised. So please proceed, Mr. Brown. Oh, no.
Yes, I was watching CNBC this morning, and they said that the head of BlackRock said that they were going to have a lost decade of asset allocation. And I was also watching the head of CalPERS, and they were addressing basically the 7% return, and it seems like there's a lot of trouble afloat in the next decade.
I concur, and I have a few slides to address that going forward, but let me save until I get that. But given where the equity market is now, future returns are going to be, the U.S. equity market are going to be challenging. And secondly, in your core fixed income portfolio, which is somewhere between 16 and 25%, depending on the system, given what the Fed has done, we've had extraordinary returns in those portfolios. But going forward, given the low rates, the future returns look less robust. And it just draws to attention that all of us are going to have to deal with is what do we do with our core fixed income portfolio going forward, because it's served us extraordinarily well, both in returns and diversification. And it's not an easy question, particularly given the basket clause constraints that we face. So yes, the next decade is going to be challenging, I think, for returns for all of our funds.
Thank you.
Other questions for Mike? At this point, he's not done yet, so this is not your last chance. Okay, I don't see any mics, so please proceed.
Oh, Mike, this is Ray Santander.
Morning, Ray.
Okay, Ray,
how are you,
go
Mike?
ahead.
Good.
Question for you, Mike, is, and we had I think I'd asked you at the last time you were here, how much room is left for the Fed to stimulate the economy? I know we're a reserve currency and so forth, but are we bumping up against what the government is able to do or the Fed is able to do?
Yeah, absolutely, yes. Bumping up against the constraint, but not exhausted. This Fed, with Jay Powell as chair, has been clear he does not intend to lower rates into negative territory. So assuming that holds, they can't lower the policy rate any further. What they can do is increase QE. They can increase it in terms of actual dollars of QE, but they can also increase the duration of the purchases. So buy further out the curve to drive down long rates even lower. So they're not done. There is more they can do. And you being a student of this stuff are aware they put in new programs this time to backstop investment grade credit, municipal credit, and a variety of other programs. And there is much firepower left in those programs if we get some widening of credit spreads. So, if we use the baseball analogy, where are they in innings of near the end of their game? I would say somewhere 6th, 7th inning.
Oh, well, we better go into extra innings, Mike, because we might need it.
Agreed.
Thank you.
Mike? It's
Joe,
Joe
good morning.
Alejandro. Good morning. I'm sure part of this answer was in some of your response, but maybe I need a little bit clearer answer. Ed asked you about CNBC and the lost decade. Is there any difference here, given what we've gone through in the last 9 months, that we really haven't gone through in other events? And I'm not talking about a pandemic. I'm talking about the result fiscally and monetarily than, let's say, 08, through some of the other crises that we had, the tech bubble, the accounting scandals, some of the other events. I mean, those seem minor, the tech bubble and everything else, but I'm talking about the big collapse in 08, where we can't recover quickly comparatively to the economy. So, and obviously, if we can't recover, we can't recover. But I think we'll all have a problem at that point. Everybody will have a serious problem. So, can you just address that? How you see, for example, that we can't recover a lot of the losses quickly?
Joe, is your question about the equity market, the economy, or both?
It's going to be about both because they're all somewhat connected, right?
Yeah. The scenario you describe is one of the really adverse scenarios for all of our pension funds.
The black swan scenarios, right? So.
Yeah, and certainly this was a black swan. I mean, no one predicted COVID.
Right.
Black swan event. And the monetary policy response and the fiscal policy response is unprecedented. And the graph that Diane left up, the table on the right, I think encaptures the magnitude of the response that we've had and how big it's been. And in my opinion, that's helped dramatically bring equity and fixed income markets to these, bounce back in the equity market and this phenomenal rally in fixed income. You've heard me harp about rates before. I showed the graph of the history of interest rates in the U.S. and we've made new lows from those time periods. So what's an example of how we get into a worse situation and the markets can't bounce back? Let's say, as an example, COVID has, a massive second wave that results in a massive increase of infections and more hospitalizations and more deaths. Do we, as a society, as government policy, have the same degree of monetary policy response and fiscal policy response? I don't think so. We can do more in fiscal policy, but that being said, our deficit as a percent of GDP is over 100%, which is very unusual. The only time we did that previously was World War II. And at some point, there becomes a tipping point, and that becomes problematic for the credit of our country. So those things are worrisome. And I would say that the thing that keeps me up at night is the scenario you described, where the equity market goes down and stays down for a decade, because we're not going to get that bounce back. And let's just say we did scenario analysis for that. What would we do? We pride ourselves in being long-term investors. We ride out volatility. We rebalance into volatility, meaning when the equities are down, we try and buy equities down. We try and sell what's up. But our hands are very tied to the beta that the market provides. So it is a source of concern. And again, as I mentioned, if we were to, as a group, meaning the consultants, BAM, and obviously the trustees could make the decisions, were to change our asset allocation and reduce our core fixed income, given the forward-looking returns, begs the question, what would we do with the money? Where would we put the money to allow both diversification, stability, and return potential? It's not an easy answer. Bond markets are expensive, equity markets are expensive, private markets are expensive, and we have a basket clause constraint. So I don't have a soothing answer for you.
Yeah, no, I hear you, and I didn't expect you to have an answer that the Federal Reserve and others don't have an easy answer for it. It gets down to our credit worthiness and the ability to deal with these uncertain markets going forward. No one has an easy answer for anything, right? So,
right.
But I appreciate your response. I mean, we're just going to wind up being in debt a little longer.
Yes. Our children and grandchildren are going to have to deal with it.
Yes. Okay. Thank you.
You're welcome. John Adler, may I continue?
Can I have one more question, Eddie?
Sure, of course, Ed.
Yes, there was an article in the Wall Street Journal yesterday about Treasury notes, tips. And it was saying at the current rate, if you buy a 10-year Treasury note, you can expect to lose on an annualized basis roughly $1 for every $100 you own. It also means you might not want to own Treasuries at all. Talking about getting into stocks, gold, and corporate bonds. Now, I know we use that as an inflationary, what's the story on tips?
Yes, we hold tips as we divide your assets into three broad categories: growth assets, inflation protection assets, and deflation protection assets. Tips are absolutely part of the inflation protection assets. I don't agree with the journal article that you're going to necessarily lose money on tips at these levels. They do have negative real yields, but where they serve all of your portfolios well is in a rising inflationary environment, that it's going to offer a positive return, not a negative return. Because the coupon associated with the tips varies with a piece of the CPI data that comes out on a monthly basis. So tips not only will offer a positive return in a rising inflationary environment, most importantly, they'll offer diversity to the Treasury portfolio, the long Treasury portfolio, which in theory is supposed to go down in price in a rising inflation environment. I say in theory because if the Fed's buying them all, they may not go down.
Right, but they also say that real yields are what you get on U.S. government bonds after compensating for inflation.
Yes, those are negative. Real yields, so the yield minus the inflation rate, are negative. That is, the Fed will never admit to this, but that's intentional. They want to make government rates extraordinarily low in order to stimulate the economy and also get investors to move out the risk curve, with the theory being that if financial markets are strong, that supports the economy. That's certainly something I agree with, but the degree of correlation has certainly decreased over the last decade as monetary policy has carried a lot of weight. And that's what I alluded to both you and to Joe, that we collectively, all of us, have some big decisions on what to do with our core fixed income portfolio going forward, because the forward-looking returns on fixed income, on credit, on mortgages are dismal. And again, we have a lot of AUM in those asset classes.
Okay, thank you.
Welcome.
I think you can proceed, Mike.
Okay. Next slide, please, Diane. So this is a section talking about current and future concerns. Obviously, COVID is the driver of the economy, and the potential for, to reopen, or have to shut down again, or certain sectors of the economy shut down, certain universities shut down, certain school systems, and that's going to be the most important driver. The one thing I will note on a positive COVID development is while COVID cases remain uncomfortably high, the death rate has plunged. And that is both due to, I would argue, younger people getting COVID, who have a much lower mortality rate, as well as increased efficacy by the fantastic job the doctors have done, the use of coagulants, the use of remdesivir, a whole bunch of different things. So And why does that matter? If we do get a second outbreak as we head into the fall and the flu season, markets at this point don't expect a widespread economic shutdown. Second thing, the pace of the economic recovery. Dan in the risk presentation is going to spend some time on that. But if I was just to scroll through a whole bunch of economic graphs, both government releases as well as mobility data, they all look like a V down and then some partial V up, and then they kind of go sideways. So whether you want to call that a square root sign, the Nike swoosh sign, but the vast majority of charts look that direction. And then the other things listed here, I'm going to talk a little more in depth with the exception of US, China. So next slide, please. So the Federal Reserve underwent an 18-month monetary policy framework review. They just announced the results of this at the Jackson Hole Conference in late August. And what drove the review was almost 10 years of the Fed missing on their inflation target, which as a reminder is 2%. So it's important for the markets and the economy to believe in the Fed and that they can achieve their goals. So they've done some adjustments to their monetary policy framework throughout this review. So two key results from that. And the first is the inflation. And at the end of that, I gave you a new acronym, not me, it's a new acronym in markets, AIT, stand for Average Inflation Targeting. So what the Fed is doing now is trying to achieve inflation that averages 2% over time. Over the last 5 years, inflation has averaged more like 1.6 or 1.7. So now there's a period of Fed policy's goal is to have inflation higher than its target, higher than 2%, to average 2% over time. The second key change was in employment. As a reminder, there was a concept called NAIRU, the natural unemployment rate without accelerating wages. And so they've diluted that a little bit, and they've given themselves a lot more latitude to assess the shortfalls of inflation away from the maximum level. Getting away from the economics theory here, what does this mean to us? It means the Fed's going to be much more dovish, lower rates for a longer period of time. All this going on while they're trying to increase inflation, and with the federal deficit being the largest it's been since World War II. And I would argue that the risk to the deficit is to go higher, not lower. So this gets back into what I was talking about, core fixed income. Markets expect the policy rate, which is at zero, it's at a range between 0 and 0.25, to remain that way all the way through 2024, and some even to 20 and 25. So core fixed income is going to be a topic that we're all going to be spending some time on in the future. Next slide, please. I want to spend a little bit of time on the U.S. equity market and the valuations that are historically expensive. And this gets into both what Eddie mentioned this morning about the next decade looking difficult and what Joe was probing at as well. How are we going to expect these kind of returns going forward given the valuations, the extreme valuations where we are now? And it's been driven by just a handful of stocks, of mega cap tech stocks and social media stocks. What's different these times is these stocks are highly profitable. And this slide we've seen before. This is from Goldman Sachs, and it divides the equity market into degrees of valuations with 10 different deciles. And we are in the 10th most expensive decile, which is on the far right and surrounded by that red rectangular shape. And again, based on history, going back 70 some odd years, using these same this five-factor model, what should we expect if historical returns follow, if future returns follow historical returns? That's that 0.1% you see in that red rectangle. A 0.1% represents the average annual return over the next 5 years. The red dot represents how many years the market will be positive. And again, that's only a third of the time. So if history were to hold, we have a difficult US equity market going forward. Next slide, please. And here's just a few more slides to enunciate what I mentioned in the beginning. So upper left, this is the S&P 500 2 years PE ratio, so price over earnings. The red dot is where we exist at the beginning of September. And you can see, other than the NASDAQ bubble, we've never had an S&P 500 at these levels price earnings. Slide on the right, the top line shows the market cap of the top 20 firms relative to the total equity market. The blue line shows the top 5 firms, and it lists them. And this should be alarming to us. This talks about the concentration in the equity market of just a handful of firms that are driving the returns. And again, as a reminder, the Russell 3000, S&P 500 are market capitalization weights. So the higher market cap firms have a greater degree of influence on the index than the lower ones. So we've never had a market so concentrated in the past. And then in terms of profitability, if we go to the bottom left, this shows the free cash flow for the 10 largest stocks in the S&P. And this is more comforting. So you can see the cash flow, free cash flow is extraordinarily positive, remains that way. And one could argue that's supportive of these valuations. And on the right-hand side, this is the S&P excluding financials and REITs and net profit margins. And you can see the blue dot, which was at the end of August. So still, profit margins still remain very high within the S&P. And that blip up and that blip down that you see, the blip up had to do with a corporate tax rate announced in 2017. And the blip down is just that coming out of the 3-month average data. So you smooth that out, and the profit margins remain very high. But before we leave this, just as a reminder as to what popped the NASDAQ bubble in the late 90s, early 2000, a variety of factors, but most market historians would argue the Justice Department suing Microsoft over anti-competitive behavior. And in the news the past few days and weeks, we've seen the Justice Department is suing Google and I believe Facebook as well. So concerns going forward, as I would say. Next slide, please. So it's hard to talk about markets without talking about the election. And my intent is not to make this any type of opinion, but just to represent how markets are thinking about the election. And the two things I want to talk about is the potential policy differences between a Biden victory, a Trump victory, or divided government. And then secondly, how the election outcome could be a possible source of extraordinary uncertainty and market volatility. So next slide. Let's talk about policy differences first. With a Trump victory, we haven't gotten a lot from the Republicans on what a second term would look like. So the market's views are a similar type of agenda, but with a large infrastructure program associated with that. The president has been explicit about the need for that, his want for that, and I think even Pelosi has been in agreement with that. All sorts of questions, around that program. How do we pay for it? Are there offsetting spending cuts or tax increases? Is it all deficit financed? So that's kind of where the markets feel with a Trump victory. A Biden victory, in his election platform, he's laid out some very specific proposals or agenda, and it's both an increase in tax revenue of the vicinity of $4 to $5 trillion, and that would be both increases in corporate tax, both the tax rate and inclusion of those who have to pay taxes, meaning he wants to get a minimum tax rate for a lot of different companies who do this country tax arbitrage, and also individual taxes going up. Also on Biden's platform is a massive increase in spending, and you can see that on the right-hand side of the slide. And again, what's in an election platform and what gets passed is not necessarily the same, and that gets to the point on divided government. History has shown that the markets do better in divided government. It forces them to compromise. It forces them to work together. And as a reminder, the House is currently under the Democrats' control and strong consensus that it remains that way. The Senate, a lot of uncertainty around that. And again, as a reminder, the Republicans control the Senate now with a 3-seat majority, but there's 23 Republican and only 12 Democratic seats up for election. So the outcome of the Senate remains more concerning. or more uncertain, I should say. And again, it's not just who wins the presidential election, but who maintains the Senate, and whether we end up with divided government or a government with one party in charge. And before I leave this slide, I would say that market consensus in a Biden victory and the Democrats hold the House and win the Senate, and they do away with the filibuster in the Senate, there's the view that they can pass a lot of their agenda, and market consensus would be that would be negative for the equity market, given the drop in earnings per share associated with the increase in corporate taxes. Next slide, please. So this is an intent to, these next couple of slides are just to kind of show the framework for the election and how it could be a possible source of uncertainty. So we'll start with the basics. The debates start the end of the month. They go through as the schedule outlines. On the right, most political pundits are in agreement that the Democrats are widely expected to win 233 electoral college votes, the Republicans to safely win 204, and it leaves 101 key battlegrounds, 6 battleground states accounting for 101 electoral college votes that are going to dictate who wins this election. And the good news on these 6 battleground states, Florida and Arizona, both count their mail-in ballots in advance. So on election night, when they declare the winner of their state, it is with a high certainty of the mail-in ballot counting that's been done. On the bad news, 3 of these states, Michigan, Pennsylvania, Wisconsin, don't start counting their mail-in votes until the polls have closed. So what they declare on election night will be for votes that are cast, not including the mail-in ballots. So it's likely on election night we're not going to know the outcome given the ballot counting for these 3 states. Next slide, please. This is just a map with the red and blue showing the different states and their electoral votes, with the beige ones, I guess they should probably be purple, showing the 6 key battleground states. Next slide, please. So this slide is to show the importance of Florida. Starting in the upper left, if Biden wins Florida and those 233 votes are safe, that will give Biden 262 votes. So you can see that in the middle. And of the remaining 5 states, he only needs to win one of those 5 states for a path to 270 votes. Below that, if Biden does not win Florida, then he's going to have to capture 3 of those 5 battleground states. And in the upper right, if Trump wins Florida, that gets him to 233 electoral college votes, meaning he'll need 3 of those 5 battleground states to win the electoral college. And in the bottom right, if Trump does not win Florida, he needs to sweep all 5 of those battleground states in order to win. So this gets to the importance of Florida, and given all the machinations that went on in 2000, which was 1 county in 1 state, Florida has actually done a lot to increase their process, both the mailing out of the ballots, how they account for them, when they count them, so on and so forth. So fingers crossed that Florida goes smoothly, and if it does, you can see the outcome on the election. Who wins Florida on how that's going to be so important to the outcome. Next slide, please. So I wanted to show this because it's this complex, said differently, potential chaotic schedule that we may face. And why is this greater than 0 probability? Given COVID, the mail-in ballots are expected to be significantly higher than what we've ever faced before in our country. So as a reminder of how the process works and with the dates associated and laid out by the Constitution, states all have about a month to count their ballots, go through any legal disputes, with the mail-in ballots, the accuracy of them, the legitimacy of them, and obviously a lot of potential lawsuits around that. They have a month to get through all that. The Electoral College meets on December 14th. If there's not 270 votes for either candidate, then the Electoral College is disbanded, and the Constitution lays out a process that's called a contingent election. So that will take place between January 6th and January 20th. Not going to go through all the machinations of that. Easy thing to Google. But the other point to remember is on Inauguration Day, if the process has not resulted in a winner in the contingent election, then there's no path for the president to stay as president until this process is resolved. It doesn't mean that he couldn't ultimately win, but for some period of time he would not be president. And this was the point I wanted to bring up. You can only imagine the noise around this if we go through all these processes. It is going to be chaotic. It is going to be, both sides are going to have a lot of lawsuits going on. A lot of it's going to go right to the Supreme Court. And it's going to be a high degree of uncertainty and what I think would be a great degree of volatility within markets. And I will just say that as a reminder, our asset allocation is diversified across asset classes, across geographies, and across types of assets that we're invested in. It was built to withstand volatility, and I can confidently say that we will be at or very close to all of your strategic asset allocation targets going into this. So we will be where we all agree that we need to be over long periods of time. That concludes my remarks for current issues. So let me pause there for a second before we go into your portfolios.
Questions? Donald Nesbitt.
Good morning. I just have a question on the projections in regards to a Biden win. And you can tell me if I'm correct. Did you say that it will be negative on the asset allocations? And what are you basing that upon? Is it that with corporate tax going up, or is the feeling that corporations will do business elsewhere?
It's very simple, and this is my opinion only, so take it for what it's worth. It's what I stated: if Biden wins and the Democrats take over the Senate, and lastly, that they get rid of the veto power. I'm sorry, I got the wrong word. I've lost it for a second. But if the Democrats filibuster, if they get rid of the filibuster, then the Democrats would have a lot of power in passing their agenda. And if they have passed the agenda that is on the Biden platform, it calls for an increase in corporate taxes and also a minimum tax that large corporations have to pay, and thus would eliminate or reduce the ability for some of these large corporations to not pay their taxes due to domiciling themselves in different countries. So my opinion is that with a higher corporate tax rate, corporate earnings would go down on the simple fact they pay more taxes, and that would be negative for the U.S. equity market, and that would be hurtful to all of our portfolios.
Okay, thank you.
You're welcome.
Any other questions for Mike at this point? Okay, please continue.
Next slide, please. So your portfolios. Before we go to the bubble charts, I want to just remind you of the rebalancing activity that's taken place in Q2. On this slide, we show it by both system, and then we aggregate it at the bottom in the total. And again, as a reminder, different systems pass the new asset allocation at different times between February and June. So showing just a snapshot of Q2, it captures that. And if you look at the bottom, the bulk of the activity has been reducing duration. And each system reduced duration in the new asset allocation. And given the drop in yields, we felt it prudent to get to those target durations sooner rather than later. And I'm happy to report that under Robert's leadership, we are within basis points, if not on your duration targets. Next slide, please. So again, there's, I'm going to show 3 slides here: the growth portfolio, the inflation protection portfolio, and the deflation protection portfolio. And in quarters past, we've had tilts being underweight U.S. equities, overweight international. We no longer have that. The only tilts in the portfolio are very small tilts in both police and fire, and they are a small over allocation to hedge funds and a small under allocation to U.S. equities. Those worked phenomenally well in Q1, worked not so well in Q2. And again, there's some noise on these, and I would just remind you that all of your portfolios are in transition to your new targets. So the noise around these has more to do with the transitioning to those new targets rather than any tactical tilts. And again, this is a snapshot as of June 30. If we were to show you a snapshot today, all of those bubbles would be closer to that middle line. Next slide, please. In terms of inflation protection assets, you can see close to target everywhere here. Bank loans sticks out as being above everything. And as a reminder, every system chose not to invest in bank loans going forward. So Wes is underway liquidating those portfolios, and that's been going quite well. And again, if I was to show you that picture today, all those bubbles would be closer to the middle of the line, and they will be there shortly. Next slide, please. This is your deflation protection portfolio. Said differently, it's your core fixed income portfolio, and you see bubbles all over the place on here. So just a few things. Let's talk about credit first. You know, police, your dot sticks out very low. Again, as a reminder, you passed your asset allocation a little bit later than others, so we didn't get to your moving into investment grade. We are in the process of doing that now. The Treasury line shows a little bit of, you know, all over the place kind of thing. You know, some of the, if you recall from the first slide of rebalancing, some of this money has flown into cash. So and there's a 0 allocation to cash. So some of you combine the 2 of those, they kind of get those closer to where they want. And then again, as a reminder, next slide, please. What matters in core fixed income more than the AUM is the duration of your portfolio. And what you see here on the second row is the new inflation target, the new duration targets adopted by each board. And on the bottom row is where those durations were at the end of June. And you can see they've all come down to where they were. They've gone lower previous month and going towards your the board adopting duration targets. And again, if I was to show you that as of today, they would be right on or within, you know, plus or minus 5 basis points. That concludes my remarks on your portfolios and everything else. So again, let me just pause there for any comments.
Any additional questions for Mike? If you would use the raise hand button in your participants tab. Donald, if you just lower yours unless you're wanting to ask another question, which you are free to. So I don't see any other questions. Mike, thank you very much for that comprehensive presentation.
Thanks, John.
So Alex, are you up now?
I am. We'll jump into performance for each system. So next page. So just quickly, snapshot of AUM by system for the fiscal year that ended June 30th. And you'll see in aggregate, AUM is about 214 billion. Next slide. So we'll pause here a second to go through this. So you'll see here returns for the second quarter of the calendar year and also the fiscal year and trailing 3 and 5 year periods. For the last quarter of the fiscal year, the system's performance ranged anywhere from 9.81% for police to 11.11% for BRRRRs. And the fiscal year returns ranged anywhere from 3.85% for NYSERS to 5.72% for BRRRRs. So as you know, after a tough first quarter of the calendar year, that is, the system strongly rebounded in the second quarter, as you can see here in the 3 months performance, in line with the strong rebound in the global equity markets. However, the systems did underperform an index portfolio, as you can see in the next to bottom line of this chart, where it says public markets equivalent 65.35. Now that is primarily due to the index, the reference portfolio, having a higher rate weighting to both US equities and EFI markets, world developed markets ex-US. So that equity component of that reference portfolio, the index at 65%, is roughly divided into 43% US and 22% EFI. By comparison, the systems are about, with their new target allocations to equities, call it about 44% on average across the 5 systems. And the breakdown of that 44% is about 28% US, 10% EFI, the balance 6% being EM. So our relative underweighting, particularly the US markets in the quarter, is the reason why we would be trailing that reference portfolio. Now for police and fire, a couple of things to note. You might notice some relative underperformance versus the other 3 systems, and that is due to your lower allocation to equities. So in this month where equity strongly rebounded, that hurt on the margin. In addition, in your US equity portfolio, you do have some exposure, relative exposure to value-oriented managers. Those were a bit of a drag on performance. As we know, the rally has been led a lot by large mega cap tech companies. And then your hedge fund portfolio also underperformed a bit in the quarter. So that accounts for that little bit of difference there I wanted to highlight. For NYSERS, I'll mention, it was interesting, for this quarter, which is typically not the case, NYSERS benefited from its China screen. So I'll talk about that a little bit later, but the China screen in the quarter was actually a benefit, given the performance of some of the segments that are not excluded, i.e. Singapore and some other jurisdictions where the managers are overweight given your exclusions. Again, I would add that similar to police and fire, NYSERS has some value exposure, relative value exposure in US equities that was also a drag. And lastly, for BRRS, which was a relative outperformer versus the other systems in the quarter, that would be primarily due to BRRS's higher exposure to equities. So that would make sense given that they have a higher target to US equities, and they have very strong EFI returns, which I'll comment more about later. So that accounts a little bit for the variations and the differences between the systems. Lastly, I'll mention and just point out, I should say, that despite the strong rally and rebound in the second quarter, the systems do lag or lag the 7% assumed rate of return for the fiscal year. And certain systems are also lagging the index in the 3 and 5 year trailing periods. Now, for all systems, excluding NYSERS, yes, they have relatively outperformed the index portfolio and other large pension plans as measured by TUX in the trailing 3 and 5 year periods. And last but not least, as a reminder, the TUX figures, which is the last line of this chart, of this table, always presented gross of fees. Next slide, please. So here we have now total portfolio performance for each system in the quarter versus each system's custom benchmark. And it's a little bit hard to tell given the scaling, but all systems just slightly underperformed their custom benchmarks, with the exception of BRRS, which slightly outperformed their custom benchmark. As Mike was alluding to in his prior presentation, it's important to note that there is some noise in these figures, and that's because the benchmark weights still reflect the old asset allocations for those systems that approve their new asset allocation in mid to late second quarter. So that would be police and BRRS, again, which approved their new asset allocation in mid to late second quarter. Your benchmarks are still your old benchmarks, so that creates some noise. But we expect, or we have, I should say, moved your benchmarks to your new weightings, reflecting your new asset allocation as of the beginning of the third quarter. In addition, I would add that for teachers, NYSERS, and fire, this page does reflect your current new benchmarks because you all approved your asset allocations in Q1. But it's important to note that throughout the second quarter, BAM was moving each system towards their new targets. So that creates, again, some noise in comparing your performance versus the benchmarks, which we have reflected as of the beginning of the quarter. And yet we were working throughout the quarter to reach your target allocations, which still has not been completed. So we would presume, or we would expect, continued noise in these figures when you compare to your benchmarks as we complete the implementation of your new asset allocation. Next slide, please. So here we're breaking down the components that contributed to the lag, that slight lag, as I mentioned, for all systems excluding BRRS in the quarter versus each system's respective benchmark. Again, as I just mentioned, the asset allocation effect, that middle column where you see the lag is noisy, again, given the timing of executing on the system's new asset allocation targets. Now, the relative underperformance for the systems excluding BRRS this quarter, due to asset allocation, is primarily, again, driven by the underweight to U.S. equities. So we had a very strong performance, as I mentioned on that first 2 slides ago, on overall performance in U.S. equities. So a slight underweight there was a detractor. And in addition, the system's slight overweight to cash and short-term treasuries was a drag on performance. For BRRS, I'll just mention, since they had excess returns versus their benchmark in the quarter, that is primarily driven, BRRS, by very strong performance by your EFI managers. That's why in the far right-hand column, you will see the manager value add bar for BRRS in the green is 182 basis points. Next slide, please. So here we show U.S. equities versus each system's benchmark for the quarter. You'll see in the far left-hand quadrant there, performance ranged anywhere from a negative 70 basis points for police to a positive 18 basis points for teachers. Sticking with teachers, your outperformance was driven by Brown, your small cap growth manager, and Cook and Bieler, small cap value manager. Now for NYSERS, police, and fire, some of the underperformance you see on this slide was driven, as I again previously mentioned, your value-oriented managers. So think research affiliates and scientific beta. However, for police, fire, and NYSERS, there's your exposure to Cook and Bieler and Pzena, and for just police and fire, Brown, helped to mitigate the extent of some of that underperformance. Those managers performed well. And for BRRS, your outperformance was driven by Wasatch, a small cap growth manager, as you know. Turning to EFI on the next slide. So for the quarter, the system strongly outperformed. And this is a very strong performance, as you can see, 403 basis points for fire to 965 basis points for BRRS. Now, across all systems, Baillie Gifford just had an outstanding quarter as their focus on some companies focus on the digital economy, e-commerce, outperformed, obviously, the traditional economy stocks. Now, for all systems excluding BRRS, Causeway also outperformed, which was a good reversal from their underperformance in Q1. And for BRRS, your very strong outperformance was due to your portfolio concentration, which is relatively concentrated in fewer managers than the other systems, and those managers did incredibly well. So again, think Bailey Gifford, blowout quarter, higher concentration in your portfolio to Bailey and EFI leads to that almost 1,000 basis point outperformance in the quarter. Emerging markets, next page, please. So here we show emerging markets. The performance ranged anywhere from a negative 161 basis points for BRRRRs to 349 basis points for NYSERS. Excuse me. Now for all systems, excluding BRRRRs, Bailey Gifford, again in EM and emerging markets outperformed. Now for NYSERS, and this comes back to what I mentioned in the prior page on your country screen in this quarter, your relative outperformance that you can see there at 349 basis points was due to your country screen. The actual benchmark returned about 20%, 20.3% to be exact, versus 18% for the MSCI Emerging Market Index. However, I will point, as you know, that over the last 3 years, the custom benchmark for NYSERS, emerging markets benchmark for NYSERS, has trailed the MSCI Emerging Market Index by about 379 basis points. And lastly, for BRRRRs, Acadian, the sole active manager, underperformed. Next slide. So here we have your fixed income portfolio. I'll go through this quickly. As you heard in the markets overview, performance, and you can see it here on the left-hand side, was largely in line, we'll call it, versus each system's benchmark. What I would highlight in fixed income is certainly your mortgage managers and investment grade credit as managers outperformed in the quarter. Next slide. So high yield returns rebounded, significantly in the second quarter. However, despite strong returns and strong absolute returns, I should say, of about 10%, 9.9% to be exact, all systems, excluding BRRRRs, underperformed their relative benchmark. And that's largely due to the underweight your portfolios have to energy, and energy strongly rebounded in the second quarter with a 39% return. I just mentioned for BRRRRs, the relative outperformance was due to its 50% allocation to MacKay Shields, and MacKay Shields was the sole outperforming manager versus the benchmark on a net basis. Next slide. So bank loans, as you may recall from the last quarter's report, the managers, BAM, I should say, instructed the managers, your bank loan managers, to cease making investments in February as the systems were finalizing their new asset allocation. So as a result, the managers had very high average cash balances in the portfolio, which resulted in being a drag on performance versus the benchmark. Now in Q2, we have begun liquidating the system's bank loan exposure to reflect your new target allocations to bank loans, which is 0. Next page. So quickly, ETIs underperformed slightly versus benchmarks in the quarter. Two main reasons here. First of all, you have your PPAR program where the duration of the portfolio is longer than that of the benchmark. And in a quarter where intermediates outperformed, there was the managers, the portfolio trailed the benchmark. In addition, if you look at the AFL-CIO housing investment, that also underperformed versus the benchmark, which is the Barclays Ag. And that's because corporates, a component of the Barclays Ags obviously outperformed relative to mortgages in the quarter. So that's why that part of the portfolio also underperformed the benchmark. Next slide. Hedge funds. So hedge funds slightly underperformed their benchmarks in the second quarter, as we would expect, given just a significant rebound in the equity markets. But again, if you look at the fiscal year to date, the 3-year trailing, the portfolio has outperformed and has done incredibly well. Next slide. This just breaks down the performance of the hedge fund portfolios without the impact of the tactical trade. And you see a similar trend here as well, slight underperformance in Q2, but over the longer term, very strong outperformance versus the benchmarks, as you can see. And then lastly, on the next page, the tactical trade, which again, at the end of second quarter of 18, Police and Fire reduced their U.S. Equity exposure by 1% and invested in hedge funds. The tactical trade has underperformed the benchmark in the quarter. And that's just because certain managers, you'll recall that first quarter was just an incredible, spectacular quarter in hedge funds and the managers in the tactical trade. And some of the managers gave back a small portion of that in Q2, but I emphasize a small portion in relation to the massive outperformance that they delivered in Q1. Now let's turn to private markets and go 2 slides forward, actually. Thank you. So we'll begin with the OFI portfolio. OFI is trailing the benchmark since inception, which is the public market equivalent, or PME. The PME for OFI is a blend of the Global High Yield, JP Morgan Global High Yield Index, and 50% the Credit Suisse Leveraged Loan Index, plus a 300 basis points illiquidity premium. In Q2, the portfolio had an estimated net return of about 5.5%, and that was an underperformance versus the benchmark, that blended benchmark, which delivered about a 10.3% return. I would point out that your direct lending strategies underperformed as a whole in the second quarter, as the income generated by those portfolios were offset by some unrealized mark-to-market losses. Let's turn to PE, private equity on the next page. So for PE, we have performance for this first quarter. So again, the next few asset classes are first quarter figures, as performance is reported on a lag, and that's important because first quarter was quite a depressed quarter in the equity markets, which are a benchmark, obviously, for part of the benchmark for private equity. Now, all systems outperformed their PME, which again is the Russell 3000, with BRRRR, as you can see, almost meeting the PME benchmark, which is a Russell 3000 plus a 300 basis points illiquidity premium. But again, this is largely due to the collapse of the public markets in Q1. So the PME here was meaningfully impacted by the sell down in the first quarter. Now, overall, the portfolio declined about 198 basis points in absolute returns in Q1, and that's versus fourth quarter of 19. But the PME benchmark declined by a larger number, 215 basis points. So in the first quarter of 20, since inception, returns for all systems ranged anywhere from 9.3% for NYSERS to 10.7% for FIRE. And the system's PME spread increased by 116 basis points on average from fourth quarter 19 to the first quarter of 20. In addition, I'd like to point out that the overall portfolio, the PE portfolio across systems, was down about 9.5% in Q1 versus Q4. I mentioned that because that's better than the expectations that we mentioned in last quarter. We had expected and had mentioned to you that we thought the PE portfolio would be hit about 10 to 20% in Q1, and it took a 9.5% hit, so less than anticipated. Let's turn to the next page. Thank you. On this page, you can better appreciate the positive trends in the PE portfolio through the first quarter. Once again, the y-axis here measures the PME spread or the percent outperformance or underperformance versus the public markets. Again, prior to 2011, as you know, the vintages continued to trail the market returns, with the exception of FIRE, had a slight outperformance. And post 2011, as you can see, we continue to witness strong outperformance with the 2011 through 2017 vintages group outperforming the PME by a range of anywhere of 5.6% outperformance versus the benchmark for NYSERS to a 7.3% outperformance for BRRRR. I would comment that on an absolute basis, this 2011 through 2017 vintages have returned an overall IRR of 13.4%. So a very strong performance. However, that IRR performance is down about 2.5% from the 16% that was generated in Q4 of last year of 19. And again, that's due to that mark-to-market decline in valuations in Q1. Let's turn to real estate, next page. Beginning with core. So looking core real estate. So looking at first quarter 20, since inception performance, core real estate investments are outperforming the PME benchmark for all systems excluding NYSERS. Again, the real estate benchmark has a blend of 60% Barclays Ag and 40% the Russell 3000. Given that exposure to the equity markets, that accounts for a lot of the outperformance versus the PME in the quarter. In addition, the overall core portfolio, or I should say the overall real estate portfolio, was down about 3.6% in the quarter, first quarter versus fourth quarter of 19. And once again, better than what we expected and communicated last quarter, where our expectations were for a mid-single digit hit to NAVs for real estate. And if you look at the breakdown of that negative 3.6% hit, core was down 2.1%, and your non-core portfolio in aggregate was down 6.2%. Non-core on the next page. So looking again, first quarter 20 performance since inception, non-core is again outperforming, and the same reasons. It's a favorable benchmark in Q1 given the collapse in the markets. And FIRE relative outperformance, underperformance, excuse me, for FIRE continues to be due to their meaningful exposure to some pre-GFC investments that continue to be a drag. Next page, please. So here we look at the vintage comparisons. Again, pre-2011, all systems have underperformed their PMEs, the broader markets, the exception of teachers. It's interesting that post-2011, all vintages, with the exception of 2016, are ranked either first or second quartile. And just a little comment on 2016, as you'll see there in the next to last column from the right, that grouping of funds in that vintage have underperformed. And that's the result of 4 companies that were written down. They were unrealized losses. So not bankruptcies yet, but meaningful markdowns in 4 portfolio companies in funds in the 2016 vintage, which led to the results you see on this page. And last but not least, infrastructure. So the infrastructure portfolios are now about 56% funded and diversified across 164 portfolio companies, primarily located in North America. 50% of the portfolio is located in North America and 30% is in Europe. The companies are domiciled in Europe. From a sector perspective, the portfolio's largest exposure continues to be renewables at about 25% exposure to renewables and 22% to transportation. So those are the 2 largest sectors represented in the infra portfolio. Again, the benchmarks just continue to be strong for all systems and outperforming both the PME benchmark and the IPS benchmark of CPI plus 400. Now, the infra portfolio interestingly enough, and as frankly as we expected, was the least impacted of all the private asset classes by COVID-19 in the first quarter. And that's certainly driven by the characteristics of infrastructure, the reasons why we're attracted to the asset class, and they're in your portfolios. It's their contracted revenues. Your managers in infrastructure have a high exposure to fiber, which has been certainly one of the sectors that it's benefited from the stay-at-home, work-at-home, do everything at home environment that we're in, and the long-lived nature of the assets. So the actual infra portfolio as a whole is actually up, so actually positive 4% in Q1 versus fourth quarter of 19. And on the last page, we look at performance of the mature vintages in the portfolio. And again, the systems are enjoying strong outperformance versus the public markets, driven by some of those early realizations that the systems have received, and strong performance in those managers, particularly 2013 and 2014, as you can see on this page. And those are funds that have been investing, north of 5-6 years. So with that concludes my remarks on Q2. And I'll take any questions.
John, you're muted. John, you're muted.
Can you hear me now?
Yes.
Okay, sorry about that. If you have questions for Alex on the quarterly performance report, please hit the raise hand tab on your participants tab. I have one question, Alex. The private equity write-downs for the 2016 vintage year, you said there were 4 write-downs. Are those
real estate?
Real estate. Oh, you're right. Sorry, real estate. My mistake. Are those 4 different managers, or one manager, or some variation thereof?
Correct. The former. It's 4 different managers.
Excuse me. Okay. Sorry. Any other questions? Sorry for sneezing in your ears.
Bless you, Mr. Adler.
Thank you. Thank you. Appreciate that. Okay. Any other questions? I don't see any. Alex, where do we go from here?
So now we have the risk presentation for the quarter with Dan Haas.
Well, good morning, everyone. How are you? Everyone hear me okay?
Yep.
Yes.
Great. All right. Well, thanks, Alex, and of course, good morning, everyone. Pretty simple agenda for me today. Today we'll spend a few minutes reviewing some highlights from your quarterly reports for June. And then we'll move on to examine some COVID-based stress scenarios that we examined for the portfolios. And we like those because they sort of underline some of the themes that Mike was discussing with you earlier. To bring our attention to the slide here, here as before, the top panel is an example of what you'd see on your total plan summary of your quarterly reports. You'll note that the total plan risk for the quarter ended June 30th was 15.44%, which was up significantly from the 7.35% we reported for March. This, of course, illustrates the impact to the portfolios as the long-term risk models in MSCI pick up the market dislocation that was begun in February and March. We examined this theme, as you recall, when we last spoke in June, and you can just now see it playing out on the blue box reports. Similarly, the benchmark risk, which corresponds to the portfolio policy allocation, was 14.65% in June versus the 7.49% we presented in March. We move to the right there. That is, the chart there compares our contribution to overall risk to our actual allocation. If you look at the bar plots there, the gold-colored bars, those correspond to the left-hand scale, and that shows our overall contribution to risk. And then if you examine the red dots, that's the actual asset allocation within the equity and fixed income portfolio groups. Here's before we see obviously more risk being driven by equity, no big surprise there. However, the 89% contribution to risk that we see in equity is down a bit from last quarter, where we saw 95% of our risk coming from the equities. We attribute this really to the yields coming in for our corporate and high yield investments that we think drove a bit of volatility in the fixed income portfolios. Moving down to the bottom panel, here again we plotted the 1-year trailing portfolio risk, the benchmark risk, and the beta for the period ended June 30th. As a reminder, these are forward-looking or ex-ante measures of risk over time based on MSCI's long-term models. And again, you'll notice here that the portfolio risk jumped up in April as those long-term models picked up the market events. Next slide, please, Diane. Okay, on this slide, we're showing you the factor risk decomposition featured in our quarterly packages. Investment factors, as you might recall, represent investment exposures that cut across our traditional asset classes. So it's a slightly different view of risk, but we find it very useful as we kind of dig into the portfolio. The table at the top left allows you to examine our exposures to MSCI's macro factors. The table at the top right shows which factor contributed the most to our active risk, or the tracking error. Here again, as we noted last time we spoke, the private equity factor is responsible for the majority of our tracking error, and that's just due to the application of the Russell 3000 as a benchmark to the asset class. This, again, isn't necessarily good or bad. It's just something you want to be aware of as you're reviewing the reports. And then down below, we're plotting our factor exposure among the broad equity and fixed income allocations. And again, before, you can see that risk is dominated by the equity factor, which you see is the light blue shading there. And that's followed by real estate, fixed income, and currency. I guess before we move on, if there are any questions on this material, happy to take them now, or we can take them later.
So if you have questions for Dan at this point, please hit the raise hand button. So Dan, I have a question. And I don't know if you can explain this, but you know, part of the idea of the asset allocation was to reduce our equity risk, right? That's so we took equity off the table, and yet the risk summary shows risk going up, and since the equity risk makes up most of our risk, presumably the equity risk went up. And obviously that's related to the volatility in the markets. I don't know. I'm confused by the report because we took risk off, but that doesn't show up anywhere here, I don't think, in this risk report. Could you explain that?
I think we can. Well, I don't want to speak out of school. You're absolutely right that the allocation effect as a result of our de-risking the portfolio over time is kind of muted or covered a bit by the actual increase in market volatility. So these reports don't specifically address that, but there are views we could generate that may be more responsive to that. So if you'd like, we can certainly take that back and provide you a summary with it. And unfortunately don't have that view in front of me now. Okay, I think that would be helpful. I mean, you know, we're trying to take actions on asset allocation that are, protect the portfolio. Obviously, we can't completely protect the portfolio from the volatility of the market, but it would be useful, I think, to understand how the actions we took or didn't take, affected our risk
profile or
Certainly,
something like that.
Yeah.
Okay.
We have we review a report regularly. Unfortunately, I just don't have it in front of me. Called the Risk Delta Report, which actually shows us some allocation effect relative to market phenomena. So we'll take a look at that and get you a summary. And if it's interesting to you, we can of course incorporate it, in our presentations.
Great. There's another question from Aldrin Bonilla.
Yeah, I think if I'm understanding correctly, this may be a related question in terms of how we can use this report and just understanding our risk exposure in terms of decision making and understanding like how we can reduce the risk. Saying that I think sometimes upwards of 89%, 90%, it was 94% of the risk exposure is driven by equities. And even in those areas where we're not in equities, we still have like an underlying equity risk. For me, it would be better to understand just like the common underlying risks that drive this, because just saying equity is just such a big, asset class, if you will, but just understanding the logic underneath that, like pulling the hood up and just seeing what the different levers are under it that we mean by this risk within equities broadly.
Sure. I understand exactly what you mean. It's sort of an editorial choice that we made here to present those kind of broader categories, equity and fixed income. And the idea is that it allows us to ask the question and then dig deeper into it. The risk binder, the quarterly packages that we distribute, do go down a few levels and allows you to kind of view the portfolios at the strategy level. So for instance, equity will be decomposed into public and alternative investment classes, and then you'd be able to see, our allocations to U.S. developed markets and so on that way. For the summary that I'm giving you here, I take your point completely. It is very high level, and I think if we'd like to dig into it a bit more, we can address that in a couple of different ways. We can either kind of take it offline, or we can develop a summary that's a little bit more responsive to those phenomena. What we're doing here is just trying to give you a quick overview of the overall portfolio and kind of some high level kind of attribution to what drives some of these phenomena. But it is presented, in some of the material. And we can, as I mentioned, of course, show you a little bit more detail, if that's something you'd like to see.
Thank you. For example, thank you for your response. And in particular, when you have something that's, let's say, 94% risk exposure driven by equity, and we get it down to, let's say, 89% in a certain period of time, like what were the drivers for that 3, 4, 5% reduction? Just having an understanding of that, I think.
Oh, absolutely, yeah. Maybe I glided through that a little bit. Diane, can you back us up one slide, please? Thanks. So Audrey, you mentioned that you're referring to the table here at the top right, where we see the equity bar plotting to 89%, whereas last quarter that was at 95%. What we think that, when we looked into it, what that showed was we saw comparatively more risk coming from fixed income as a result of the corporate and high yield spreads tightening. So there was more price volatility within the fixed income portfolio comparatively. And then over the course of the quarter, it consumed a little bit more of the risk. And that's what accounted for that change. Does that make sense?
Yes. So, yes. So that was like change outside of our control. That's not like, let's say, a decision that we may have made to de-risk a certain asset class, and then we're seeing the effects of that. This is just something that is what was out of our control, but it helped de-risk in a certain way that was.
Exactly. Now, and it is, I haven't looked specifically at the allocation effect for these two verticals. So it's possible there's some de-risking. Perhaps we rebalanced into those two asset classes, you know, as this market event increased the volatility to them. But it's, I attribute it mostly to the fact that there was increased price volatility within those two strategies. But as I mentioned, we have this risk delta report where we can really examine that a little more closely.
Thank you. Thank you, Mr. Adler.
John, you're muted again.
Ms. Vickers,
Thanks, John. I was just going to suggest, sort of following up on what Dan said, that, you know, some of this information is in either reports that are in the package or reports that Dan has. And if NYSERS has, you know, more specific questions or suggestions of what they'd want to see in risk reports, we can have an offline conversation about that, perhaps at a NYSERS meeting.
okay. Other questions for Dan before, he's not done yet, before he moves on? Okay, Dan, please proceed.
Okay, thank you. I will also mention, of course, that we certainly are available anytime if you see something in the reports that you're reviewing that doesn't make sense. You know, we're here to answer the questions and kind of chase things down for you. Let's see, Diane, if you don't mind going forward 2 slides. Great, thanks. Okay, so we're moving on to kind of more recent events now. As you know, of course, the market response to the monetary and fiscal stimulus programs was huge. U.S. markets are testing their all-time highs. Treasury yields are near all-time lows. Spreads, as we mentioned, have certainly tightened over the last few months. So everywhere you look, financial assets are expensive relative to their historic levels. That leads us into a discussion about the disparity between market performance and the real economy. Our team dug into that notion a little bit and found some interesting takeaways in MSCI's COVID stress scenarios. As the crisis took hold, you know, in the spring, MSCI developed 4 financial market scenarios, assuming varying degrees of severity based on impacts proposed by the IMF. In this slide, you see the macro themes that frame the magnitude of 4 specific portfolio shocks that MSCI modeled through. These range from, on the top left there, a V-shaped recovery scenario where the pandemic is relatively well controlled, long-term economic impacts are muted, and their economic recovery is relatively fast. And then those scenarios get more, or those stresses, I should say, become more and more intense as you kind of cycle through to the L-shaped recovery that you see in the bottom right there. And again, that scenario contemplates sort of a broad resurgence of the pandemic along with longer lasting economic stresses and a much longer recovery period. So again, this slide is really just meant to give you kind of thematic mileposts, if you will, on what they mean by those various recovery paths. Next slide, please. So the specific attributes that were modeled to these themes include shocks to, as you can see, you know, here, and apologies, this is a bit of a busy slide, but we'll keep it kind of general. You see shocks to near and long-term GDP growth. We see shocks to the equity risk premia, shocks to sovereign yields, spreads. There are shocks to commodity prices, or oil in this case. We have shocks to exchange rates and shocks to inflation. So as you go down there, it lists out the shocks that MSCI has promoted in these models. And then as you work your way from the least to the most severe analyses or cases, you'll see that the shocks are getting progressively worse and worse. So the punchline, can you go to the next slide, please? Here we're applying the 4 shock scenarios that MSCI calibrated on September 4th. Oh, I'm sorry, I should let me back up a little bit. MSCI released those shock views back in May, and they've been recalibrating those assumptions on a weekly basis since June. So the numbers that you saw on the last slide are changing a bit on a regular basis. The idea of this weekly recalibration is to provide a contemporaneous view of the shocks based on some assumed recovery path. So we expect the specific stresses applied to the V-shaped model, for instance, to become less rigorous or to improve more quickly than those applied to the L-shaped model. This provides kind of a useful tool for comparing the portfolios at a given point in time to an assumed recovery path at that certain point in time. So as we kind of transition into this slide, we're comparing those 4 shock scenarios that MSCI had recalibrated as of September 4th to a sample system portfolio as of August 31st. So the idea again is MSCI in their modeling has provided a sort of a glide path, if you will, for how markets would react at a given point in time to these 4 different models, and then we compare that to our portfolio at the end of August. So you'll note here that each bar color corresponds to one of the 4 scenarios. Gray would be the V-shaped recovery. The lighter blue would be the U. The navy blue is the swish scenario, and the red is the L-shaped scenario. We're plotting the estimated investment returns under each of those scenarios for the total plan on the left there, and then for selected asset class that you see kind of going off to the right. You notice the mention the applied to 831 holdings. The implication here is that our investment performance has outstripped the pace of recovery that are implied by these macroeconomic models. So you'll notice, of course, that the worse the scenario, the bigger that implied difference is. If we were to conceptualize that maybe another way, if the market performance more faithfully tracked the recovery shape of, say, the U-shaped model, you would expect to see a positive impact on the gray bars for the V-shaped or the less severe models, and then you would see effectively very small impacts to the U-shaped model, and then you'd see progressively worse negative impacts for the swish and the L-shaped models. So again, it's the portfolio as of August 31st relative to these shock scenarios that MSCI keeps up to date. The results we see here aren't really meant to imply that the market are overvalued. This is just again, it's a view relative to a macroeconomic model. We know that the Fed is likely to remain an accommodative force for some time to come. We know that the current administration is making a strong market performance a pillar of the re-election campaign. You know, one thing is for certain, none of these scenarios are actually going to play out. There are a lot of assumptions that are baked into these that don't necessarily reflect reality. However, we think there is value in comparing the macroeconomic models to the market because it gives you a sense of how quickly markets have recovered and also helps to contextualize that relative to some structural phenomena. I think these stress scenarios, therefore, are kind of directionally correct, but you know, magnitudinally, it really could play out any number of ways. That kind of concludes my comments on this section. Are there any questions?
Any questions for Dan? Dan, I have one more question. So the slide on the COVID scenario analysis that talks about portfolio valuations, what period of time does that cover?
Sure. Can you back up 2 slides, please, Dan?
Yeah, that one. No,
okay.
Keep going.
This is the slide you're referring to?
No, the one after that.
Okay, gotcha.
The scenario analysis, that one. Yeah.
So this model is meant to be forward-looking. You can think of it as hypothetically an instantaneous change in the portfolio as of August 31st. So it's a point in time estimate that would imply a market change. So there isn't really a forward-looking time change. The model doesn't suggest that, you know, in a month we would expect this level of decline. It doesn't opine on volatility. The way the model works is that based on the covariance matrix of the investments within our portfolio, were we to apply these stresses, the valuation of the portfolio would be X at a given point in time. Does that make sense?
Not really. It doesn't make sense to me, but I don't want to belabor the point because I don't want to belabor the point. It's okay.
Okay,
Any
I'm
other
happy
questions?
to kind of.
Maybe we can talk
let's-
offline
we
because
can-
we're running very behind.
Right,
We
right.
can do it.
A little bit more time, perhaps I can find a more eloquent answer for you, but I'm happy to
That's
take
okay.
that offline and follow up with you.
Okay, thanks. Ray Santander, you have a question for Dan?
Yes. Hi, Dan.
Hi.
My question is, was there a probability assigned to each of the different recoveries? I mean, you presented 4 scenarios, and if we get the L-shaped scenario, then that would be very, very bad news indeed. But is there a likelihood or a greater likelihood of, one against the other, given what we know at this time?
Yeah, unfortunately, there is not. In the material that MSCI put out on these scenarios, they didn't want to be prescriptive in terms of assuming that, of saying we have X% chance of hitting an L-shaped scenario, for instance. What they were trying to do is it's really a thought experiment on their part that where they imply some market shocks to the portfolio.
Okay, thank you.
Sure.
Okay, any other questions for Dan? Okay, thank you, Dan.
Thank you, everyone. Have a great day.
So Alex, does that conclude the performance reporting, the quarterly
Yes, it
reporting
does.
for today? And does that conclude the public agenda?
Yes, it does.
Great, okay. So thank you. So with that, we're going to entertain motions to exit public and go into executive session. Diane, could you remove your screen so I can see the whole, there must be some other way to do it, but yeah, perfect. Thank you so much. Okay, so we're going to take it in the reverse order that we started. At the Fire Pension Fund, can I get a motion to exit public session and enter executive session?
Motion.
Mr. Guilfoyle, thank you. Is there a
Second, it's
second?
Terrell.
Thank you, Ms. Brown. Any discussion? All in favor of the motion at Fire, please unmute yourselves and say aye.
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 Okay, great. Any opposed, please say nay. Any abstentions? Okay, motion carries at Fire. At Police, can I get a motion to enter?
PBA makes a
executive
motion
session?
to go into executive session.
Second, Controller's Office.
Who is Controller's Office? Second,
That was
thank you.
Joe
PBA and
Alejandro?
Controller's Office.
Yes.
Joe Alejandro made the motion, John Dorsey second.
Yeah. Yep, exactly. Okay, any discussion at Police? All in favor of the motion at Police to exit public session, enter executive session, please say aye.
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 All opposed, please say nay. Any abstentions? Okay, motion carries at Police. At NYSERS, is there a motion to exit public session and enter executive session?
So moved, Lawrence Bosley.
Lawrence Bosley, thank you. Is there a second at
Second.
NYSERS?
Second, Aldrin
Mr.
Bonilla.
Bonilla. Yeah, Bonilla, thank you. Okay, any discussion at NYSERS? All in favor of the motion at NYSERS to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. And at Teachers, is there a motion to exit public session and enter executive session?
Tom Brown, so moved.
Thank you, Mr. Brown. Is there a second?
Deborah Penny, second.
second.
Oh, I got Deborah.
Ms. Penny, thank you. Okay, great. Any discussion? All in favor of the motion at Teachers, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. We are now in executive session at all the convened boards. Can we please turn the cameras off and we will proceed. Let me ask any members of the public and